Aloha. Welcome to Ably Seminars sessions. Today's lesson is going to be on the different types of loans that are available to the consumer, and usually to owner occupants, as well as to owner investors. One of the most common loans that we see is what they call conventional loan. The conventional loan is defined as if you pay 20% down and you borrow 80% from the bank, then that's a conventional loan. If you pay 5% down and get 85% mortgage, that's not a conventional loan. Because the banking industry or the federal government says that a loan should have 20% down and you can get an 80% loan. But there are other programs where you don't have to have as much down payment. So let's talk about the other loans then. FHA loans, Federal Housing Administration loans, are insured by the federal government, and the borrower only needs to come up with 3.5% down, and they can borrow the rest from the bank or participating lender. So FHA loans allow owner occupants to be able to borrow money with a much lower down payment. And the payment is insured to a certain percentage by the federal government in case the borrower defaults. FHA loans are only for owner occupants, and you must live there. The next one, which is very popular with veterans, is called a Veterans Administration loan. This is a sweetheart deal, because if you've been active duty and you had honorable discharge, or less than a dishonorable discharge is the way the definition runs, then you can get a VA loan. So you can be active duty or retired veteran, you qualify. VA loans, as they call them, is 100% loan. You don't need to put up any money for down payment. In fact, they give you some money for closing costs and for escrow fees. So really, it's 102.5% loan or around there. So veterans get a special deal. And VA loans are guaranteed by the Veterans Administration that the lenders will not suffer a loss beyond a certain percentage of the loan. And that loan is called a VA loan that's guaranteed by VA. FHA loans are insured by the federal government. In Hawaii, we have what we call a hula mai loan. And you go, what the heck is a hula mai loan? This is when the state legislature says, hey, let's raise about $120 million in bond money so that we can then loan this money to first-time home buyers that are bona fide citizens or residents of Hawaii. So participating lenders will say, hey, I'll take $20 million of the $100 million. And so the $100 million or $120 million is spoken for by the different banks that participate. And once the money is all used up, then the hula mai loans are gone for the year. And every year, the legislature allocates or authorizes X amount to be raised through the bond market. So what's the advantage of hula mai loans? Hula mai loans are usually a little lower in interest rate, and it's only for first-time buyers. So if you've never owned a home for the last 3 years, you qualify for hula mai. And you can only get one hula mai loan in your lifetime. So let's say you are married, got a hula mai loan, got divorced, sold the property. Neither husband or wife can qualify for any more hula mai loans. It's only once in your lifetime. But it's a pretty good deal because they have a lower interest rate. They also have what they call ERS loan, State Retirement System loan. And this is for all employees that are covered under the retirement system for the county workers and the state employees. And so the state retirement system has money to lend for qualified workers under the state retirement system. So there's lots of different ways to be able to get a loan. Another loan that's popular is called a reverse mortgage. And this is for seniors who are 62 or older, and they have a lot of equity, and they have a lot of equity in their home, but they don't have much cash flow. And they don't want to sell their house. They want to stay in the neighborhood where they raise the children. So the federal government has a program that says you can stay in your house, and based on your equity, we'll give you monthly payments. That's why they call that a reverse annuity mortgage. And so the borrower collects the money and does their living expense, covers their living expenses, and they don't have to make any payments back until the borrower dies. Then the estate of that decedent will either refinance with the children refinancing, or they'll sell the property and pay back any of the mortgage payments that were made, plus the accrued interest that was never paid. And then if there's any money left over, then the heirs get the difference. So they got really creative programs available for different types of people. So hopefully you learn a little bit more about different types of programs that are available, from 20% down to nothing down. Aloha.